Hey everybody, welcome to another episode of the Remote Real Estate Investor. I'm Michael Albaum, and today I'm joined by my co-host Tom Schneider, as well as a very special guest, Chris Naghibi, who's the Chief Credit Officer for First Foundation Bank. And Chris is going to be talking to us today about lending overall and what we as real estate investors need to be aware of. So let's get into it. Awesome, Chris. Well, welcome to the show. Thank you so much for taking the time to come and hang out with Tom, and I really appreciate you.
Well, thank you guys. I appreciate you guys having me on.
Yeah, absolutely. So for all of our listeners out there, would love to know and have you share a little bit about your background and how you got into the real estate space and kind of what you're doing today.
You know, my background's kind of been schizophrenic. I look at my own resume sometimes and I wonder like how this path has taken me where I'm at. I'm an attorney by trade. We started a bank in October 2007. And somewhere along the way, I felt like I fell in love with real estate. I'd done it since I was a kid. My father, when I was 14, handed me a cold call list and told me to call everybody and told me that for everybody I got to give him an application, he'd give me $500. Well, the first day I made $1,000 and he refused to pay me. But I never stopped falling in love with real estate and kind of the concept of the fact that we all have to know about it. And then I eventually, branched out, started a law firm, started my own real estate company, and I still work at the bank. We're publicly traded, and it's just it's been a wild ride, but that's my crazy background.
What are some unexpected things in starting a bank? Like I love that. Yeah, we started a bank. Like what are your, I guess, 3 takeaways that you were unexpected assumptions, or I don't know. You can take them any direction. So 3.
Oh yeah,
bullet points.
There's a lot of
unexpected
unexpected assumptions.
Yeah.
Well, let me tell you 3 bullet points about starting a bank. It's hard. It's a lot harder than you think. I think people think regulators like, oh, the SEC, or it's have some little bit of oversight. Regulators are very strict. When you start a bank, you have to write a business plan out for 3 years in advance, and then you have to stick to that business plan for 3 years. Except we started a bank in October 2007.
Yeah.
Great time to get into banking.
Probably not the best written business plan given the market, but we rolled with it nonetheless. The second thing is relationships are so vital. You can grow a bank and you can do such a huge thing, but relationships are the truest form of currency, right? Well, if you're starting a bank and you're trying to build something from the ground up like any business, a bank is no different. Who you know and how much they believe in you really matters. And the third thing, businesses scale differently and banks definitely scale in a very unique way. It's a slow grind over time, but money builds money, and interest rates are such a pure form of building passive income, and banks make such a huge amount of money from it, but it takes years to get there. So our original idea of, we'll sell in 5 to 7 years. Well, that didn't go very well, did it? It's been 14, 15 years now. So, but it's a long game.
Interesting.
Yeah.
Do you think, Chris, that you got into becoming an attorney because your father, breached a contract? You're like, oh, I gotta, I never want to let this happen again.
You dirty real estate brokers. No, my dad, my dad actually went to law school with me. How weird of a story is that? My dad, I'm
really?
6'5". My dad's 5'5", fat little dude, looks like Danny DeVito. I love him to death, but you would look at him and go, wait a minute, that's so. Anyway, we went to law school together. It was a kind of a later on in life venture for him, and it was his way to motivate me because I just wanted to be in real estate. I was working. I didn't want to do this, and he's like, well, if I can do it, you can do it too. And that was a terrible idea because everywhere you go, you're now like the cute little idiot standing next to him while he's in law school, and like, look at you, your son, he's so cute. And well, we did it together. He actually works with me in my law firm to this day, but he's been a huge motivator for me to try to get more understanding of the business. I think when I was a kid, when I was working with my dad, the one thing that I really wanted, I took home from that relationship is that he didn't know the entire business. He knew the single family side and didn't know, business lending or commercial real estate or multifamily real estate, kind of my passion. And I wanted to know so much more. And the more I started to research and get into it, the more he did too. And now we kind of geek out together on some of the stuff, which is also weird, but that's what we do.
Did you ever see that movie Twins with Arnold Schwarzenegger and Danny DeVito?
Yeah, that's like my dad, except, well,
That's what it reminds me of.
I'm not buff or good looking, but if that were the case, I'd be your Arnold Schwarzenegger.
It'd be a perfect.
Yeah.
That's great. So I would love to kind of take the conversation and focus a little bit into lending, because I think it's an area that a lot of real estate investors, there's just a lot of clouds, I think, surrounding, and people go talk to different folks and get different answers. And so it's tough to really nail down. So from your experience, who is the best candidate to receive lending? If I'm I want to be a real estate investor. I'm just getting started. How do I set myself up to go get a really great mortgage?
So, I mean, you're talking just for your home or for like an investment property, because there's a very different investor profile.
For as a pure investment.
And I want to make sure we delineate that, because I think there's a lot of confusion as it relates to buying a home for yourself to live in and buying a home that's going to be an investment property for someone else to be in. I actually went down this path. So when I first started buying investment real estate, I was buying single family residential real estate because I couldn't afford the bigger stuff. And I tried to figure out that profile too, because I wanted to be that guy. I wanted to be the profile. And now as the chief credit officer of a bank, I kind of define the box. There's a couple nuances that I think people are confused about. Is they think that when they buy an investment property, that property's cash flow is going to benefit them and it's going to make their application a lot more attractive to banks. Well, it doesn't work that way. It's based on your historical income. It's based on what you've done, and do you have an ability to repay this mortgage? Do you have the ability to pay it as a second property under your current cash flow? So the first thing I would tell you, if you're looking to get into real estate and you think there's going to be exponential growth, it's going to take you time, just like the banking business, like when we first talked about that. You have to have a good, stable source of income, verifiable income. And if you don't, there are some alternatives for hard money lending, and there's other alternatives there. But if you want that takeout financing, and whether you want to go interest only in a 3 to 5 year product, or you want to go in a 30-year fixed product, whatever your investment methodology is, you have to plan on being able to pay for the mortgage that you're getting. Another question that I commonly see a lot is, how much do I have to put down? And that varies so much based on risk profile, right? Like how much you need to put down based on risk profile of your own choosing. How much do you want to have in the property? How much can you afford? But also, where's that property located and what are the rents like? You want to make sure it cash flows. So I'll tell you, if you want to buy investment real estate and you want to be the ideal candidate, you need to have cash flow and you need to have an understanding of the market, because your understanding of the market is going to be clearly shown in your application. Because if you're going to buy a property that makes financial sense, it's going to make financial sense for the banks, for the lenders. Because a lender and a bank are always going to look at a worst case event scenario of default. If you default on this property, can we turn it around and sell it and not lose money? And the more equity you have in the property, the more attractive it is. The more experience you have, that actually matters to a bank. Stuff like that.
In buying several rental properties myself and using different lenders, I've found that the qualifying income has been inconsistent, where some banks haven't accepted the rent that was, collected, and some have, and some would count my other rentals that are, have been leased out for a long time, and some wouldn't. I mean, is there a lot of leeway in underwriting process, or is that something that's standardized at a federal level?
All right, so we're going to get into some cheat codes. And This is my favorite one.
All right, good.
So keep in mind, this is a guy, who started the bank, right? You got to find the portfolio lender, right? You need to understand a basic concept as a real estate investor as it pertains to single-family homes. There are agency lenders and there are non-agency lenders. The agency lenders are typically people who conform to Fannie Mae agency guidance. And that's a very rigid box, right? It's like when you go to a big box bank, a Bank of America, a Wells, a Chase, whoever you're going to, they have a very tight window of what fits in their niche. And if you don't fit that, they're just going to say no. And unless you're a private wealth management client, they're not going to give you an opportunity to opine. The answer is just no. What I always tell people is one of the most undervalued assets for a real estate investor is a community or regional or super regional bank where somebody knows your name. And I'm not quoting Cheers. It's just true. The bankers know you, right? And the other aspect of a community or regional bank or whoever they might be is if they are not selling into the secondary market, and usually that's a way larger banks manage their liquidity, right? Sell some assets off, get some more liquidity, make some more loans. So it works out well for them. But for a smaller bank, you want to grow your assets in size, increase your interest producing assets. So how do you do that? You make more loans, you hold them in a portfolio, but they know they can't compete with the Wells, the Chase, the B of A. So their guidance, their credit policy, their broad document which outlines what they can and can't do is generally not based on agency guidelines. And they're a lot more flexible. They're able to make some of those discretionary decisions like, Tom and Michael are good guys. They're investing in this. We believe this is their first one. They might be short here on PITI, but we can make a policy exception to it. And your personal relationship with matters, right? It goes right back to that first statement that we made, relationships are the truest form of currency, and we all have a relationship with the bank. It's just who have you chosen to have your relationship with?
That makes total sense. And so how would somebody, if I'm a borrower, I'm a buyer, I want to go buy investment property, how would I know whether the bank is a conforming or non-conforming bank?
Well, you can ask. I mean, it's not a confidential thing. What I would typically tell people is that the more you get into real estate and the more you start looking around, the more you start figuring out the relationships that are more personal, And as a result of that, you'll know who's really not an agency lender. Because I'll tell you, dead giveaway, if you have to call into a 1-800 number and it's a call center, that's an agency bank. They're going to go traditional Fannie conforming guidance. If you're talking to an individual in a bank and they're actually helping you out and telling you what's going on, that's usually somebody who's a local or regional bank. But that's a very easy thing. You can ask them. They'll tell you straight up whether they keep it in their portfolio or not. There's nothing wrong with telling you that and disclosing that. In Southern California, I could probably name all of them in my area just because I've got loans with all of them now myself, and I compete with them in the banking space. And as you become a more and more seasoned real estate investor, you need to know that. And the typical reason why is, let's say you even if you conform to agency guidelines, and let's say you have all the cash flow, you have all the net worth, you have 6 months of PITI, and let's say you're able to put down more money because these are non-owner occupied investment properties, and let's say you're okay putting it in your individual name because agency lenders will require that, or a trust. You still you still get a limit. Fannie Mae has a limit of 10 properties they're typically going to lend to you. And after that, you really can't go traditional agency anymore because you're considered to be too risky of an investment for the secondary market. So you're going to if you succeed at this, you're going to have to know those community regional banks because they're the only ones that are going to lend to you at a certain point. And that's where a lot of these online gurus and people that are they're selling you these plans for $100 and hey, do all these things. These strategies are great. They kind of leave out that detail of there's a cap there unless you figure out the market.
One more question in talking about community banks. Credit unions, this may be a dumb question, but difference? I mean, I don't know, them looking to go get a loan, like talking to a credit union versus a bank, are they like sometimes like the same? Or I don't know, if you could just kind of spiel on that. I think it's one of those things that people hear a lot, but don't necessarily understand the difference. And
yeah, well, I mean, they're different types of institutions, right? And we look at them and we walk by them, we drive by them, and we don't really think much. We think bank. They hold money. I give them money. They lend out money. It's a bank. A credit union has a lot more of that relationship-based feel. That's kind of why they are credit unions in the first place, is they have to have a nexus to you in the form of relation. And the reason why that nexus, that relationship is so critical and vital to what they do is because everybody who comes in there has this connection. And because they have this connection, you're talking with individuals. You're not calling 1-800 numbers typically unless you're dealing with a very large credit union. There's a very few of those in the United States. They do have that flexibility. They do have different lending standards. They do have different lending guidelines, and you can usually have those conversations. One of the biggest benefits I tell people from credit unions you get, though, is you get better interest rates. You typically get better interest rates from the credit unions. You typically get a little bit more credit flexibility and a little bit more insight into what's going on. And you also have that relationship-based level that you would get at a community bank. I would say that if you're a real estate investor and you want to go into something like an LLC, as your name on title, and you want to hold it there for passive income purposes, for tax write-off purposes, you probably can't do that at your local credit union, but you can do that at a portfolio-based bank, depending on their risk profile, their tolerances. In states like California, where there's a single action rule, banks typically like that because they know that in a worst case event scenario of default, they can just take the property back from you. They don't have to go to court. They just file a deficiency judgment, take the property back.
Makes sense. As a remote investor, how would that change the calculus in evaluating, we're looking for local relationships or credit unions? And am I shopping more in my local, let's say I'm in California, am I talking to my local credit union to go buy properties in, I don't know, St. Louis or something? Or am I talking to local credit unions or community banks in St. Louis? I'd love to hear your insight on that, on local lending versus kind of that relationship.
And it's going to be a lot of repetitive thoughts kind of running through it. And I'll tell you, I have to do this too. So a lot of my real estate portfolio is in Oklahoma and Texas. I live in Southern California. So is it easy for me to get out there and get loans? If I wanted to go through Bank of America, which I believe I have on one loan, I can do that easily. Yeah, I can go to them, but I have to fit that box. And I'm at a size now that portfolio size is not going to resonate well with them. Banks typically look at that as saying, this person carries way more mortgages, which brings down my credit score a little bit because I've got all this outstanding debt. But at the same time, they look at me as an increased risk because people who have more properties just have inherently more risk associated with them. So it winds up being this long conversation. So I've been forced to understand that market and get to know that market. And the one thing I can tell you is, if you want to be a remote real estate investor and you want to be completely hands-off, you really have to trust your team. You have to trust your financing people in the market. You have to trust your property manager in the market. You have to trust the people that are there. And if you don't trust them implicitly, you're far enough away to where you won't see what's happening. So I always tell people to go to the area. You have to get to know the market. You have to get to know the bankers. You have to get to know the community. So I typically go to markets that are new that I want to invest in. And I'm a real estate agent. I'm a real estate broker, and I want to chop it up. I want to talk to the real estate agents and brokers that are in the area. I want to get their feel. it would be a very foolish errand to walk into a community, let's say like in Oklahoma. I own a lot of real estate in a suburb called Edmond, which is a northwestern suburb of Oklahoma City. I would be foolish to walk into that market and acted like I knew what was going on. Like I knew who was moving in, who was moving out, what the flavor of certain neighborhoods was as far as rent appetite goes. I couldn't do that. So I have to rely on local talent. But in having those conversations, one of the things I always ask, who's your go-to bank and why? And you start hearing the same names over and over again in the market of who the players are that understand the real estate investor and understand what's going on and who's really trying to scale portfolios. And you go talk to them. You sit down. I did that literally the last time I was out there. I sat down with a bank, a smaller community bank. I think they were about $100, maybe $200 million in size. Not a massive bank. And said, look, I want to talk to you guys about my relationship. And they gave me two offers right off the bat. Hey, we could look at a commercial line of credit for $1 million where you could, use this to buy real estate and then we could refinance it off. Or we can look at financing just single family real estate as you go through, or we're going to want 5% more down. And that conversation's evolved over time. I've gotten to know them a lot better. And now I know that anything in Oklahoma I want to go to, I go to them. They're going to take care of it for me. And they already have my financials. They already have my information. I'll usually give them an updated tax return if the time has come. I don't have to resubmit an entirely new application. I sign an application. I update what financials they already have. You go to a big box bank, you're filling out all that information all over again.
Yeah. It's such a stark difference as someone also who has portfolio loans and standard loans. I mean, I give this anecdote all the time when talking about portfolio loans. I literally called up my banker on a portfolio loan and I said, hey, look, the interest rates have dropped. I'm at 4.5. What can you do? He goes, yep, no problem. Let's do a loan modification, drop you to 3.25. How's that sound? I was like, great. And yeah, you try that with a Bank of America or Wells. I mean, go through a whole refinance process, pay the points, do the song, do the dance. I mean, it is just such a different experience with the portfolio lender and one that I'm a huge fan of.
Yeah, but see that relationship, you could make that call. You could literally call somebody. You have a point person. You could call. You can ask the question. And it's simple how easy it was to get the answer that you needed because you have that relationship-based business. And that's how all businesses should scale. But once you get to a certain point, you can't reach all people. And honestly, if you want to feel like a concierge level service, that's the kind of lender you got to be with.
Yeah. Yeah. So, and Chris, in talking about this, I mean, I know that portfolio loans are amazing. Community banks are really great relationship partners. What's the difference? I mean, we talked about the relationship side. We talked about kind of the structuring of the loan itself. Why wouldn't everybody go to a community bank as opposed to their big banks down the street?
Man, we struggle with this a lot. I mean, obviously growing a bank, getting the answer to that question is vital to us growing and scaling, right? And I'll tell you that there's the perception, particularly after the Great Recession, where everybody said, hey, these banks could fail. I could lose all my money. Let's put that to bed right now. Every bank has FDIC insurance, and FDIC insurance, and I'm watering this down, is good for about $250,000 per account. You have more money than that in an account, there's no guarantees on that on the insurance, and people are always worried about runs on money. Could this bank fail? Banks are very highly regulated, whether that's the Federal Reserve, the FDIC, the DFPI in California, wherever your regulators are, they're very heavily regulated. There are capital requirements. There's all sorts of significant things that banks have to go through in order to make sure that they can last. So once you dispel with the idea that banks are going to go under or they could go under or they're perceived as riskier, you have to deal with the value proposition of these brands. Wells Fargo, Chase, B of A, they are the Coca-Colas of the industry. You walk into a restaurant, you say, give me a Coke. People think banking, I'm going to go to Wells Fargo, I'm going to go to Chase. They do it because these places have brick and mortar locations on every single corner. And these brick and mortar locations are highly visible. You see them when you drive through in your neighborhood, your friends go there, you see people coming in and out, they're right next to a restaurant. It's easy to be intoxicated and fall in love with that location and proximity and think that you got yourself a better situation. But in reality, other than the fact that you can walk into a bank, you're generally not going to get better service. As a matter of fact, these smaller community regional presences usually have a direct number, like the contact you shared you experienced, right? Mm-hmm. You usually have people who you know. If you want to talk to someone like me, the chief credit officer, you just give me a call. I share my mobile number with everybody, and I've had a number of people call and complain that they didn't get the loan they wanted. But nonetheless, it's. But I'm open, and we're not a small institution anymore. We're about $7 billion in size, maybe a little bigger, and you can still reach out and talk to me. You can ask me what happened, and I'll explain it to you. You're not going to get that with the Wells and Chase and B of A, but people feel like that brand name, that value proposition in them being big makes them safer or gives them a better product. And I can tell you that it really doesn't. You usually get a lot better product because the product is designed and fits your needs, and you have the ability to reach out and connect with people at a smaller community regional bank. And the world's digital now. We talk a lot about cryptocurrency. Well, the US dollar is effectively digital. People move it around all the time. And I can tell you that at a bank that's online heavily and not so much brick and mortar, they're not paying those massive leases. They can afford to give you better rates.
Yeah. So, I mean, that segues really nicely to my next question. I was going to say, well, if you're getting the better service, it must be more expensive, right? If I'm going to go get a portfolio loan, I'm probably going to be paying a lot higher interest rate than I would at a Wells or a Chase, right?
Yeah. So when you're selling in the secondary market, like a Wells, Chase, B of A, and you're pricing your portfolio, you're pricing the portfolio with how much can I sell this for in the secondary market? I'm going to package it together in a pool of loans, and I'm going to sell it off in a security. And that security's got to have a yield to the investors. And that yield has to be in line with market. Otherwise, they get paid a discount, or they have to pay a discount for the person to buy it from them. Or if the rate's really good, they get paid a premium for them, for the Wall Street to buy this, pool of securitized assets from them. So they're always thinking with that in mind, where a portfolio lender is thinking about the weighted average coupon of their portfolio and how they can get the best return for their investors, and if they're publicly traded, for the shareholders. So believe it or not, that's a lot easier of a decision when you're looking at putting something in a portfolio and you're thinking about a relationship, right? If our biggest challenge is not pricing business, it's getting business. I'm going to price the business as good as possible to get your business, to win your relationship, because I want you as a real estate investor to come back and do another one with me. And I know it's going to be difficult for you to go to a regular bank and a regular size, Wells Fargo, B of A, Chase, these big names. I know it's going to be difficult for you to do that. So I'm going to try to do my best to win your relationship on price, because that's the one thing I really can compete on, that and obviously the exception side. So you're actually going to pay market, if not a little bit less than market, with some of these banks.
Interesting. So as someone kind of getting back to who is the ideal candidate for lending, how can somebody start to form that relationship with a local portfolio lender, with a community bank? I mean, I'm a guy, I'm just getting started. I might not have any deals under my belt. I walk in there. Is anybody going to be interested in even talking to me? How does that work?
Yeah. That's the strangest question. I get it all the time. So I spend a lot of time traveling around talking to kids about financial literacy, and I get this question all the time. Like, I don't have any relationships. I don't know anybody. And I'm like, you got a checking account, right? Well, yeah. Okay, then you have a relationship with the bank. Now, if they don't value your relationship and you don't know anybody there, you should probably move that relationship. And they're like, oh, well, how hard is that? And it's funny. We don't really set up bank accounts unless you're a real estate investor or a business owner. And even if you are a business owner, you're not setting up bank accounts like every day. So you're like, oh my God, do I just take the money out? Do I just close it? Does that affect my credit? No, it doesn't affect your credit. You take the money out and you just go open up another one after you close the other account with your local bank. And then you start building that relationship. Very few people actually ask me that question on a daily basis when they're just getting started, and I wish they would. The easiest way for someone to get started with a bank is to find a bank that does what you want to do or specializes in it. There are banks that specialize in small businesses. There's banks that specialize in real estate. Find the bank that fits the profile of investor you want to be, and then ask them, hey, what are your internal guidelines? What do I need? I want to buy this property. I want to buy a property that looks like this. And those bankers will tell you, because they want to win your business and they want to nurture that relationship. So what I can tell you right now, if you're a first-time real estate investor and you want to get out there and you've got a primary residence, make sure you have an excess of cash flow, pay down your debts, do the simple, logical things. Don't look to the crazy stuff. I hear this all the time. The weird advice, don't borrow from your 401k or your retirement. Don't borrow money on credit cards. Be smart, be reasonable, be prudent. It's short-term pain for long-term success.
Love it.
In talking about banks that specialize, I'd love to know, when you started the bank, like what problem were you solving, or what sort of, opportunity that you saw kind of on the other side and the starting the bank.
Well, from the lending side, so I serve as a chief credit officer, and my main function is to design a credit program which would enable us to grow and scale at an accelerated rate while being prudent and sound in our investment decisions, and we did refer to loans as investments, in such a way that we could accommodate a very robust business in the state in our local proximity. And for us, that happened to be multifamily real estate. We are the second largest multifamily real estate lender in the state of California, and we're branching out pretty significantly. We just grew to Dallas. We're looking at a couple different avenues in different states. And we're already in Hawaii and Las Vegas, and we've been able to grow and scale that business by making loans to real estate investors specifically to overcome these same objections we've been talking about. The same problems that the first-time real estate investor challenges that are there, those same problems are the same problems that a 100-unit apartment owner has. They want a relationship-based business. They want to be able to deal with as little hurdles as possible, and they want to get through the brain trauma of a real estate transaction without feeling like somebody just, gave them a colorectal exam.
Yeah.
And sometimes getting a loan can feel that way.
Yeah.
So
cavity search. Yeah.
Yeah. I had, I kid you not, on my own personal primary residence, I went through a lender whose name shall not be mentioned, and it took them 5 months to go through my entire portfolio of real estate and come back, and they asked me for more information. 5 months of this process back and forth. I literally hated that phone number when it popped up towards the end. Like, I didn't want to talk to this person. I was ready to pay whatever rate possible to not deal with him. But so that was the problem we were trying to solve is we don't sacrifice credit quality for price, but what I will give you is one of the best experiences in the lending realm that you could possibly ask for. We're going to give you that concierge level service. We're going to give you the value proposition that you as a seasoned real estate investor deserves. And we're going to build our brand off the fact that you get a great product, you get great service, and you know how to get a hold of me, sadly.
Yeah.
But yeah.
It's so funny you mentioned that. I talk to folks all the time about, look, it's important to get a great product at a great rate, but if you literally want to bang your head against the wall every time you have to call this person, it might be worth paying a little bit more just to get the deal done or to get the service. I mean, so it's so prudent and so timely that you're mentioning this.
Well, yeah, and I'll tell you that, that real estate hasn't changed much in the last 50, 100 years. Like, we still use this archaic methodology. And look, I'm a real estate agent and a broker as well. I do that, on the side for my friends and family. And I really love the business. It's a passion project. But what I do is really outdated. Why I would get paid 2.5% or somebody else would get paid 2.5%. I understand that's the industry norm, but by today's technology standards, there's got to be a better, more efficient way. And lending is way worse when the way we do things. You think about all the things that we're giving somebody. This is all digital. Your tax return, your financial statements. You should be able to just log into Plaid and send them over, and everybody has what they have within a couple of clicks, but it doesn't work that way. And the underwriting process is still not, it's not electronic. It's not AI. It's an individual looking at these things, asking questions, and things get missed. It's a very, very painful process. It's shocking to me to this day that it hasn't changed so much in the last 50 years. I hope that there's change coming that'll make our lives easier on the real estate side. Maybe the blockchain is the solution. We can buy and sell real estate quickly, but it's painful. And you can grow a business to billions of dollars in size if you can just give exceptional customer service and be weary of people's frustrations like your own. How crazy is that?
Yeah. Mind-boggling, I know.
I'm thinking of some other questions that just keep popping up. So, as the chief credit officer for the past 14 years, how much movement is there in the underwriting, criteria or things that you think about? I mean, we've had such a wild run over the past, 10, 12 years. And then there was the deep hole. Like, I'd love to hear how it has evolved in the underwriting, either criteria or I'll let you go ahead and just kind of riff on that.
No one's ever asked me that question before. So kudos to you. I will tell you that it has evolved a lot. Particularly around the 2007, 2010 range, people were freaking out because of the Great Recession. They're like, oh my God, what's going to happen? And this actually comes right up to just this last year and what happened with the pandemic. So in normal response, okay, banks look at investment real estate from a cash flow perspective. If you're a 1 to 4, you're still a single family. They're still looking at your cash flow as opposed to the property's cash flow. And the only way they really look at your portfolio cash flow is look at what was on your historic tax returns. But when you get into some of the bigger properties and you start looking at 5+ units, they start looking at the cash flow of the property first, the equity in the property second, and then you as a sponsor, a guarantor, if it's a full recourse loan, as a tertiary source of repayment. So the policy that we have set forth in the credit policies is very broad, overbroad document, and all banks have a credit policy. But really what gets tweaked, the dials that get tweaked are things like your policy and procedure underneath that, your guidance, the suggestions for daily activity. And if you're an underwriter and you're working on something, what do you look at? So believe it or not, the de minimis dollar amounts and like things like debt service coverage ratio, the cash flow on the property for every dollar in cash flow, your expense, that ratio, that hasn't changed a whole lot in the credit policy. It's always been a certain de minimis number for like multifamily, let's say 115 on average. For a little bit in 2007, you saw lenders go up to 125. They wanted to build in a little more cash flow reserve. But really what's changed has been kind of the rate that we use to qualify you on the multifamily side. And on the single family side, it's been the optics and things like investment properties. And the reason why those things have changed, they've figured out that when things get bad, like in a pandemic, is that investment property more at risk? Probably. If you have a higher qualifying rate on a loan, that means you actually have more cash flow in reality coming into your pocket. You're probably going to bear through the financial wherewithal of a storm. And the perfect storm was the recent one. In the multifamily world, the pandemic happened, right? Then you have eviction moratoriums, and people are like, oh my God, am I not going to collect rents? And Moody's and CoStar and Reese and everybody came out and they said, okay, well, you know what? Rent collections on the first of the month have gone down to about 70, 80%. And people were freaking out. And banks had a knee-jerk response. They wanted to see things like more documentation of tenants being there. Are they paying? So now they're asking for updated bank statements. They want to make sure that your tenants are actually paying and they're not, somebody who's taking advantage of the eviction moratorium. That became an additional level of scrutiny that was not really a policy-based thing, but that was just how it operated. But believe it or not, through the rest of the month, when you started looking at rent collection through the month, not as opposed to just when it's due in the first, you were still above 90%. So a lot of this knee-jerk reaction that banks were taking sounded like a real conservative methodology, sounded smart, sounded great, but in practice, people were still getting paid. And the eviction moratoriums across the country, and there's some people who I'm sure were impacted significantly, but the large majority of operators did okay. So it's constantly fluid. They're going to try to do the most prudent thing they can in a market while still being able to lend. It's very rare the regulators will step in unless you're a troubled bank or troubled lender and say you have to do X, you have to do Y. The most recent example of that was the Dodd-Frank Reform Act on the single family side, which is why ability to repay or your ability to buy a property is so critical. Banks and lenders get really judged on that. So they have to make sure that you really can pay for those mortgages, because prior to that, people were getting stated income loans. They really couldn't qualify for it. There was no income verification and things were getting kind of nutty. Well, today, you really, really can't do that. They have to find a tangible way to show that you have an ability to repay. I know a long-winded answer, Tom. Sorry.
No, I like it. I mean,
that's great.
I was just thinking, as a lending company, man, must have like really great insight on like what that, these multifamilies through the pandemic, their ability to pay back their loans. And, we've talked a couple of times in the podcast just amongst ourselves that there hasn't really been that big of an impact on our portfolios that we have. And that's interesting to hear you say, maybe it's just the timing of the payback has been, I definitely get it that there was probably people who have had issues, both on the ability to pay the rent themselves and then be able to pay the loan. But I don't know, we haven't been as impacted by it or haven't noticed it.
So I'll tell you this as a metric, and this is public knowledge. I'm not telling you anything you don't know. We have a portfolio of several $1 billion in multifamily. Obviously, we are the second largest lender in Southern California, so we have a lot. I don't think I had a single deferral in our portfolio. And if we did, it may have been one out of the entire portfolio, somebody that called in and requested a payment deferral. I will say that certain people like agency lenders, Freddie Mac, for example, happens to buy the majority of the multifamily debt on the secondary market. They had a very loose policy as it relates to this. So what they did is, if you called them up and said, hey, I need a payment deferral, they would give you one, and then you had 12 months from the expiration of the deferral, usually around 3 months, to pay all that money back that you deferred. A lot of multifamily guys heard that and they're like, that's just going to increase my cash flow, issues for the next 12 months. Or they just come out of pocket for it and move on. And they didn't go that route. Me personally, I didn't have any issues with my tenants other than some slow pay. And I know it sounds insensitive that, we're saying that didn't really impact the market and people weren't hurt. I'm not saying that. You guys aren't saying that.
Yep.
What I'm saying is a lot of people took those stimulus checks and they paid their rent, they paid their mortgage because that's where they live. Shelter is the number one vital thing that we need next to food and water, right? During this whole time, there's been a tremendous amount of insight into how the portfolio reacts and how it's responding. Another thing that I thought was really interesting was with the remote work environment, right? Like, oh my God, people are going to leave these dense areas. Is that going to affect my properties that are in denser, more metropolitan areas? And shockingly, no. I haven't seen rents decline dramatically. I haven't seen any of those things. A lot of the portfolio that I've seen, I haven't seen any of those things happen. I'm not saying that they won't, but as it sits right now, there has not been a detrimental impact to multifamily. And I know that drives economists crazy, but that's just the real world.
Yeah, similar for me with my multifamily portfolio in the Midwest. I know that in San Francisco and New York, kind of along the coast, there was a little bit of exodus and a little bit of dampening effect. But I'm sure it sounds like in Texas as well. It was in Oklahoma, things were just skating along just fine.
Yeah, there was a little bit of an influx, some of my stuff, I decided a long time ago, and this is not really a banking lending thing. I decided that Southern California real estate couldn't return me the money that I wanted from a pure cash on cash return perspective. If you want to look at cap rate, look at that. But in the Midwest, I could go in and buy something for $45,000, $50,000, get a 4-bedroom, 2-bathroom place and rent it out for, call it $1,600 to $2,000 a month with a really nice newer home, post 2000 build. And it just made so much sense from a cash on cash return perspective that we really decided to branch out in those areas. Well, those areas happen to be really highly desirable in the pandemic. So I kind of lucked out in that sense of what happened. But yeah, it was definitely different. My stuff in Southern California, maybe slow paid a little bit, but yeah. It's shocking to see from a lending perspective where we have all this aggregate data coming in, and we're very, very data heavy as an institution, to have all this information coming into us at all times, really kind of dispelling with the fears that the media are running with and that you have out there. And new investors get thrown off by this, right? Because what's the number one thing that stops people from doing things is fear, right? And if you're a real estate investor, this was a very scary last year. Like, what do? Interest rates are super low. There's bidding wars breaking out on properties. Everybody's saying the property value is going to go up next year, 3 to 5%. I should buy it right now, but there's this whole can I rent it out thing. I don't see any data that backs that fear up.
Yeah, kind of unrelated, but I think with your experience and kind of position that you're at, I'd love to hear your thoughts on the business of iBuyers. So that's, for those who are not familiar, that's companies like Zillow now and Opendoor, where they're buying these properties directly and then selling them. So it's almost like a kind of an arbitrage, these large funds that are buying and then selling. For me, that just doesn't seem sustainable. Like, in that where there are downturns, like, I don't know how those businesses survive. Anyway, just from your experience and position, I'd love to hear your thought on that.
I spent a good amount of time geeking out on iBuyers and just trying to figure out if I was missing. I had the same kind of conundrum that you do, right? Like, it doesn't seem sustainable. Like, what's going on here? So I spent an egregious amount of time. My wife was killing me. Was yelling at me every single night. Are you on the phone? Like, yeah, I am. Because I couldn't get off it. Like, it boggles my mind that this is a platform that I don't understand. I'll tell you that from my experience, buying a home is a very personal thing still. Even if you're a real estate investor, the tangible relationship that you have means something to you. If you look at a home on paper and you look at the numbers, it's really hard to make that judgment call. But physically being present or seeing it or connecting with the property or the people that you're connecting with, it makes that a much more intimate personal decision. It's not like opening up an account and buying some stock, right? There's some steps along the way. So because of that, I don't know that there's longevity in the process. We are coming into a new generation of buyers, in that you have the Gen Z that are kind of getting to that point. People are definitely waiting longer to buy. That could just because the cost of housing is going up. But iBuying is a sensational topic. It sounds great in theory. But as a guy who kind of caters to a lot of those types of buyers, I can tell you that a lot of them want to talk to somebody and say, hey, you real estate agent or you attorney, is this right? What am I doing? Can I do this? Can I do that? Can I waive my contingency on appraisal? Is that crazy? It sounds crazy. Do I have a financing contingency? Like, what is that? They want to be able to walk that through. And the iBuying platform is based on scales of economy, right? You have less individuals, you have more people in an online platform and less people to talk to. Think about it like eBay, right? You can buy real estate on eBay, at least you used to back in the day. Do you really want to do that? Or do you want to pick up the phone and call somebody and have a tangible conversation? And sadly, everybody that I've spoken to from a cultural perspective feels better with the individual. Why do you think real estate agents can still command 5% of a transaction on average or 4%? It's because that person's value to the transaction is being that conduit. And sometimes you're a psychologist. You're just listening to people's emotions. So the iBuying stuff from a scale perspective, it's interesting. I think what's got a lot more viability are syndications, and we've seen a lot of those as of late. I think you see a lot of the online buying platforms that are interesting. What I haven't seen, I think, is a phenomenal idea that somebody hasn't really done, is real estate property managers really need to find a way to get buyers in the market and be a property manager first. Not an equity partner, just a property manager first. I think you could drive a ton of business that way. Yeah. Right? If you're a property manager and you're a real estate agent and you're bringing in business to investors, I mean, essentially, it's like wholesaling but with a license. And you could bring a ton of business that way. I think that's got a lot more legs on it as the time comes. I don't think iBuying is the way of the future, at least not until perhaps the blockchain takes over and the transaction's a lot more seamless, because you still have to deal with a lender.
I love how full circle we went on the relationship currency, as well as the kind of aversion and fear of making a mistake.
Yeah, Chris, the last thing that I want to chat with you about or kind of ask is, we've throughout this episode kind of been building this profile of an ideal real estate investor, from the lending side to the relationship side. And now on the credit side, I'm just curious, what things can folks do to help boost their credit so that they're qualifying for the best mortgages? And then secondary, are there thresholds or goals that people should be looking to hit in terms of their credit score? So if I'm, again, a new investor, maybe don't have a lot of credit history or have a little bit of low credit, where should I be shooting for? What should my minimum goal be? And then also, what things could I physically do to help myself get there?
So yeah, Chief Credit Officer, this is the question I get the most, and I can tell you that there is an ideal profile, and there's a lot of kind of that old mythical information out there that doesn't make any real sense in the real world, but we believe it to be true. First of all, real estate property owners, if you own a lot of real estate, they typically don't have the highest credit scores. So if you're aiming for an 800 FICO, you're probably not a real estate investor, because here's what happens: is one of the things in the algorithm that takes into account, at least for scoring purposes, is that your total overall debt to your available credit matters, right? But if you're a real estate investor, your job is to use leverage to build cash flow and to build a bigger real estate portfolio with time. So you're naturally going to have higher usage of credit and a lot of more trade lines as it relates to mortgages, at least until you get into the commercial world and they don't show up the same way than most everybody else. So a lot of real estate investors that are seasoned, successful people, they also get sued by tenants too. And that can show up on your credit score depending on how it works and depending on what kind of lawsuit it is. So if you're aiming for a perfect credit score, don't put so much pressure on yourself. Don't do that. There are little things you can do, little thoughts that have just kind of crept up in society. The idea that credit is bad is probably the worst that I have to dispel with. Credit is not bad. Okay? People tend to use their debit card and think it's a credit card. Don't do that. Use your credit card, pay it off every single month, build that trade line up. Closing trade lines, closing a credit card, closing an account and paying it off actually does bring your score down. So be cognizant of how many credit cards you have, how many trade lines you have, and keep them out there. I have people on one side of the spectrum that come in with zero debt, high net worth clients, celebrities, they paid everything in cash, and they're like, Chris, why is my FICO like 5? Well, the answer is you don't have any credit. No one's ever extended you any credit. You've never used it, so the algorithm is outdated. The algorithm that Experian, Equifax, and TransUnion, these three private entities, use is really outdated when you think about it in the context of Airbnb, and you think about Turo, and you think about other ways people can live their life now without actually having to use credit. And it's shocking to me that we haven't updated the algorithm because it's such a baseline part of our society. And there are companies that are working to change that with AI and future forecasting of what you will spend versus what you have spent historically, looking forward versus looking back. But what I can tell you right now is you have to build credit, and you have to be strategic about it. You have to plan to spend with credit, use it, pay it down with time, and you have to plan to have a FICO in and above around, call it 700, 720 and above. You're going to get great, excellent rates there. You don't need an 800 FICO. Anything above 720 and you're going to get it. Anything, call it up 680 to 720, you should be getting great financing, but it's not the absolute best rate in some circumstances. But that's where that relationship-based bank will help you out. That credit union will help you out. You know, their flexibility to give you a top tier rate at a 680 or 700 FICO versus a 720 in their little matrix is a lot greater. And they probably will if you ask them for it. It's simple as you calling and asking for that modification. Another great thing about credit that I think people get confused about is, you know, they pay off all their debt and they think, oh, this is so great, I paid off all my debt. And why is my FICO score like 100 points lower? It's because you're not actively using credit anymore, even though you had it and it was there. So maintaining your credit is kind of more art than science in some ways. You have to understand the algorithm. If something's on your credit report, typically what I tell people, call the agencies, dispute it, look into it. They'll tell you how to get it off your credit report. They'll tell you what the steps to do. You can go hire people to do that. It's a very predatory industry, so be very, very careful if you do that. But maintaining your credit is the first thing you should do as a real estate investor. Make sure you understand it. Make sure you build it up. If you don't have a bank that you trust as a partner going forward, you should find that bank. And if you do those two things and start to build income over time, you'll be able to buy a piece of real estate a lot easier than you think, but it's not going to happen overnight.
I had a gym membership where I had auto payment, and I canceled it, and so I took my payment method out, but they still charged me for like a cancellation fee, and they sold it, you know, to another company for debt. I think it was like $50. And when I, was buying my personal occupancy, I get this notification from my bank like, oh, were you a member of Total Fitness? And I'm like, oh my gosh. So yeah, begrudgingly like sent them a hate check for $50 or whatever the stupid fee was.
Well, at least it wasn't Planet Fitness. I mean,
there you
plus
go.
One.
Yeah.
You know, it could have been that. But yeah, I hear that a lot, man. These little collections will show up, and you can pay them off, but generally when you pay them off, they won't remove them entirely. What I like to do is tell people to call and negotiate that with the person who owns the credit and say, look, if I pay you off, you have the right to deal with the original creditor if you want to, even though they'll tell you that you can't. You have that right. But you can leverage. Look, I'll pay it off. Just get it off my credit report. But call the credit reporting agencies and dispute it, and a lot of times you'll find resolution there. But yeah, it's and if you have that big box bank that Wells, Chase, B of A, they're going to want a letter of explanation. You know how many of those I've written over the years? Those are fun. Chris, why didn't you pay this $20 account? Probably because I didn't know it existed, guys. Yeah.
This was a lot of fun, Chris. And if folks have more questions for you, want to reach out to you or your bank, I mean, what's the bank called? How should they get in touch with the bank or you?
Yeah, First Foundation Bank. You can look us up online. We're the only one that I know of with that name, so you can't miss us. You can also find me on my socials. I'm very easy to get access to. It's just my first and my last name, Chris Naghibi, on everything, TikTok, everything, Instagram, you name it, I'm on it.
Awesome. Thank you, Chris.
All right, guys. Likewise. Take care.
Alrighty, everybody. That was our show. A big thank you to Chris and First Foundation Bank. This was a lot of fun. We totally geeked out on some lending stuff. I hope you got a lot out of it. I know I did. If you liked the show, please feel free to leave us a rating or review wherever it is you listen to your podcast. If you're catching this on YouTube, feel free to hit that subscribe button beneath you. And we look forward to seeing you on the next one. Happy investing.